Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Crawley.
So I would say most weeks, almost all of them, I'm pretty happy I don't do a Friday show, because who's going to listen to a show on Saturday morning about mortgage rates? But I got to tell you, I was very happy not to do a show last Friday because, my God, bloodbath in the bond market on Friday. And I thought we were going to get a little relief. Rates were up a little bit. But nothing compared to Friday. We're going to talk about that. But the 10-year yield is now at a 52-week high. In fact, we're almost at about 15-week high where we are. Mortgage rates are up. We're going to talk about that. But so it was a better day is what I'm trying to get to. It was a much better day on Monday than it was on Friday. And we got kind of an interesting week ahead. But welcome, everyone, to the Tuesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Crawley, of course, loan officer with Town Bank Mortgage right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless, of course, I'm sick, on vacation, or it is the Azalea Festival. And, in fact, I got my Azalea Festival tie on, if you're watching on YouTube, because I know technically, when does summer start? June 21st, somewhere around there, I think. The summer solstice, whenever that is. Isn't that the start of summer? I think. I might be making that up. I don't know. But so it's, I mean, even though it's not the official start, let's face it, Memorial Day weekend is the start of spring. So I thought, okay. I mean, even though Lily is sort of summery, like I always think of it as very springy. And so I'm wearing my spring ties to celebrate the end of spring as we transition, especially this far south. Like, it was amazing. I was wearing a vest. Last week? In May, I was wearing a vest? That's crazy. Because usually it's like full-blown summer. And today it definitely was. It was a hot one, reminding us that it is May here in southeastern North Carolina. Okay, we did get one report today. It did not impact rates because it was a homebuilder confidence report. I mean, it can impact rates, but it's really got to be like a swing one way or the other. This was better than expected, which is always great, but not really a market mover, I would say. So Homebuilder Confidence, National Association of Homebuilders, Wells Fargo Housing Market Index, that's the full name. It was up 3 points to 37. Markets were only expecting, I think, a 1 point increase to 35, so better than expected. That was up from 34 in April, so 3 point jump. But it was the third time this year that we've been at this level. And this year's actually been sort of elevated. At the end of last year, we were, I think, right around 30, maybe under. And so we are doing better than we have been, but still well below that middle point threshold of 50, where more builders are feeling good. When you're above 50, more builders are feeling confident than not. We're still underwater with a ranking of 37. All major components were up for the month. Current sales conditions increased 3 points to 40. Sales expectations over the next 6 months climbed to 45. And traffic of prospective buyers also rose 3 points to 25. That's always the category that keeps that index under the 50 threshold. Confidence increased across every region. The Midwest saw the biggest jump with a 6 point jump to 45. The Northeast was up 5 points to 44. South increased 2 points to 36. And the West edged up 1 point to 27. So, I mean, it still amazes me that the South is at 36. Because in Wilmington, I feel like home builders are feeling pretty confident just driving around and seeing all the buildings that are being worked on right now. But according to the stats, 36. Robert Dietz chief economist, National Association of Homebuilders, warned that affordability remains a major challenge despite the improvement in sentiment, saying, quote, recent increases for long-term interest rates will continue to hold back home buyer demand. He added that while parts of the Midwest are showing relative strength, the broader housing market continues to struggle with affordability pressures. No doubt about that. So, I mean, it's not surprising. I mean, when you're seeing a pullback in demand because of not only rates rising, but just overall kind of pessimism about the economy, that's always going to have a negative impact on home building. So the fact that we did see a 3-point rise with all of this kind of pessimism in May is still pretty good. So it means it shows that there's strength besides what is happening. Now, speaking of home builders, there was an interesting piece today in the Wall Street Journal about home builders who are getting buried in claims of shoddy construction. The Journal writes, the legal liabilities of some of America's biggest home builders, including D.R. Horton and Lennar, is it Lennar? It's Lennar, right? Have surged. It's so funny how often I see these names, but I never say them out loud until I talk about them on the podcast. And then I'm like, wait, hold on. Like I see D.R. Horton and Lennar, I think that's how you say it, all the time, but I never say it out loud. I just said it right now. They've surged in recent years as buyers increasingly sue for damages from alleged construction defects. Homeowners say the legal claims are the result of builders constructing shoddier, error-ridden homes. They allege that builders are using cheaper materials, cutting corners, and hiring unqualified and unsupervised subcontractors. Builders, however, claim that this reflects a tiny fraction of total homes that they produce, and that errors are typically the fault of subcontractors, so they could be right about that, not the companies. They also say the plaintiffs' lawyers are actively seeking out homeowners, encouraging them to pursue dubious claims with the hopes of landing a lucrative settlement. But here's what's crazy. Settlement. What did I say? Sentiment? Settlement. That's what I was trying to say there. Look at these numbers. So Lennar's, now I'm so self-conscious. I'm not saying it right. Self-insurance reserves earmarked for liabilities that insurance won't cover rose 21% in fiscal year 2025 to $336.9 million. D.R. Horton's reserves for legal claims, which exclude expectations for future claims, rose 57% to $1.1 billion from the end of fiscal year 2022 to the end of fiscal year 2025. Those are big numbers. And I mean, those get added in, right? I mean, it's an expense for the company. And so I'm not saying whether these are justified or not. What I'm saying is that that's another reason why home builders may be less than, may want to be pulling back. And then, of course, they're using subcontractors. So, they're adding subcontractors to some of the lawsuits. And so all of that is going to make builders who are already somewhat less than confident, according to the Home Builder Confidence Index, maybe even less confident in adding costs and everything else to their, overall bottom line. And so just another thing to throw on the pile, the problems with home builder confidence could be the lawsuits that are piling up, which, like I said, some people will say, well, if you just built better houses, then this wouldn't be an issue, which they, of course, are refuting, claiming that it's more about litigious law firms, which, no, maybe that's not the word I'm looking for. A litigious society, aggressive law firms, because wouldn't all law firms be litigious to some extent? All right, moving on. So let's talk about, like I said, bond, we had the 10-year was up about 3 basis points for the day, eclipsing 4.6%. Mortgage News Daily also had the 30-year fixed rate index up 3 basis points to 6.68%. So moving closer to 6.7%. We got the 10-year at 4.6%, which tells you that you're also seeing a slight rise in it's holding on, the spread between the 10-year and the 30-year. But so now we're a little bit over 200 basis points, where historically that number has been between 175 and 185. but the spread's nowhere near. I mean, if we had the same spread that we had in 22, 23, we'd be well over 7. Easily over 7. Can you guys hear that dog barking? It's outside. Where's my soundproof studio? What's going on here? Okay. But today was not that bad. Was not that bad compared to what happened on Friday. Friday, let me pull those numbers up. Those were not good. All right. The 10-year on Friday jumped to 4.59%, just under 4.6%, a 13 basis point jump, which meant rates were up 20 basis points for the week. That is the highest level since the end of January 2025. Mortgage News Daily had the fixed rate index up 13 basis points as well on Friday to close out the week, up 23 basis points. That was their highest level since the end of July 2025. So once again, thanks to that smaller spread, even though the 10-year is at like a 20-week high, the Mortgage News Daily Index mortgage rates are only up, what is that, 10 months? So better. I mean, not great, but better is my point. And so what happened on Friday, there was no major report. I think we had a New York Empire State Manufacturing report. I mean, that's not going to cause that. So what did cause it? It was more than likely just sort of a pessimism in the bond market about inflation, because we'd had that really bad CPI report, the bad PPI report. The president, of course, went to China. I don't know if there was, over optimism about what was going to be resolved or decided or talked about in China, but nothing really substantial came out of that meeting. And we really saw the bond market kind of sell off when the president was leaving China. So, I mean, that was a part of it, no doubt. So maybe there was just some bond traders that were hoping there was going to be some announcement. And while there were announcements made, I think I said this last week, I mean, do we trust China? I mean, it's more of like, I want to actually see them do that. Because how many times have they promised to buy more U.S. products and then they don't do it? And so I think there's no one who's going to be like, oh, Xi Jinping said that China was going to buy more X. It's not necessarily going to happen. But on top of it, there was actually a piece today in CNBC talking about Ed Yardney. He was the one who coined the phrase bond vigilantes back in the 90s. And he was arguing that Kevin Warsh, who of course is taking over, I think he's going to be sworn in on Friday as the new Fed chair, that he, obviously Trump wanted him to go in there and lower rates. And Steve Meehan, of course, Trump's pick, has been voting for lower, a rate cut when they vote to hold rates. And when they do cut rates, he wants a bigger rate cut. Warsh is in quite the position. There was a piece in the Journal. Let me pull that up real quick. Matt Grossman and Peter Santilli wrote in the Wall Street Journal that Kevin Warsh won the Fed chair nomination with a double-barreled policy agenda for the central bank, lower interest rates and a smaller Fed balance sheet. As he takes the reins, economic conditions will make it tough for him to achieve either of those goals. In fact, Ed Yardney argues that Warsh is set to chair the June Federal Open Market Committee meeting, but who's actually in the monetary policy driver's seat. We'd argue that it's the bond vigilantes Yardney wrote on Monday. When it comes to the sentiment of policymakers, quote, Warsh is going to be the odd man out, but he is the new Fed chair and the bond market is reacting badly to his dovish stance. And so Yardney is arguing that Warsh may actually have to raise rates to keep rates from rising, which sounds kind of weird. But basically, if bond investors think inflation is going to get out of control, then the bonds they're currently sitting on that are paying, 10-year, for example, is paying 4. Let's say you bought it 4.3, right? Let's say you bought it a couple months ago. So you're sitting on a low 4%. And let's say you think inflation could potentially get above that. Well, you're not going to want that bond. So you're going to sell that bond even if you're worth taking a loss on. And by selling the bond, it causes what? It causes the yield to rise. And so the more bond investors that sell because they're not happy with the current rate, and of course they're selling at a loss, is going to cause bond yields to rise. Because the only way someone's going to buy that bond is if they think they're going to be getting what the possible future inflation rate's going to be. And so if they think inflation is going to cool, and we are going to, then they'll buy bonds. They'll say, "Ooh, I'm going to lock in these rates." And if they feel like inflation is going to go up, then they're going to sell. And so that's why, ironically, Kevin Warsh, this is what Yardy's arguing, Kevin Warsh raising rates, cooling off the economy, pulling back, causing inflation to also cool, would actually help lower rates, because if bond investors think that rates are going to rise, they're going to sell their bonds. Or they're, like I said, they're only going to buy bonds if at a lower price to increase that yield. So either way, bond yield currently have to rise for the now. But for the long term, they could be feeling better about rates if they feel like inflation is going to slow. And so that's why it's sort of ironic that Yardney's sort of arguing that if Warsh doesn't calm these bond investors, then they're going to push rates up even higher. Now, this isn't necessarily going to happen. This is what Yardney's arguing. But it also is an explanation of kind of what we saw on Friday, where people are like, Warsh is going to have to say something about this, because now we're 3 months into the Iran war. Oil prices remain elevated, if not rising slightly. And there's only so long that producers and retailers and everyone else is going to hold on and not pass these energy costs on to consumers. And then that happens, all of a sudden now we have inflation starting to get entrenched, and we got a bigger problem. So that could be the answer for why we saw a spike in rates on Friday, potentially. All right, we're a little long today, but we got a lot to get to. This week, we got a lot of builder data. We already got construction. We got building permits, housing starts, housing completions, a lot of global inflation data, Europe, the UK also part of Europe, but we got UK, Euro area, Japan's having their own issues. So we got to keep an eye on what's happening with their inflation. Could play a big part in what's happening with our bond markets. So we got a lot of global stuff happening this week. We're going to talk about it, but you guys enjoy the rest of your Tuesday or your full Tuesday. We'll be back here Wednesday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.